embarked on an important journey of exploration and dialogue, examining the role of capital within the Islamic economy from multiple perspectives. Together, we discussed its foundations, its ethical dimensions, its role in financial institutions and capital markets, and its potential to drive sustainable development and social prosperity. Today, we continue that conversation. Over the course of today's sessions, we will examine how institutions, regulators, market participants, and policymakers can work together to strengthen the Islamic financial ecosystem, expand investment opportunities, and enhance the role of Islamic capital in supporting economic development. Most importantly, we will continue exploring how ethical foundations can be translated into practical frameworks that address the realities of a rapidly changing world. As we begin the third day of our summit, I encourage each and every one of you to continue engaging actively in the discussions, sharing your experiences, and building the partnerships that will, of course, help shape the future of the global Islamic economy. Ladies and gentlemen, we turn to our opening keynote of the day. As Islamic capital markets continue to expand, strategic vision and regulatory leadership play a critical role in unlocking new opportunities for growth, innovation, and investment. It is therefore my great pleasure to introduce a keynote address titled Empowering Islamic Investment, the Securities Commission Malaysia's 5-year strategy towards 2030. Please join me in welcoming Dato Muhammad Faiz Azmi, the Executive Chairman of the Securities Commission Malaysia.
His Excellency, the Secretary General of the Al Barker Forum, Governor Rashid, Bank Negara Malaysia, distinguished guests, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh, and good morning. Now, it's always a challenge to be the first and to reduce a vision into a few minutes. So permit me to start with a short video that kind of encapsulates what the fourth Capital Master Plan is all about. Cue video. Cue sound.
Technology is reshaping industries. Climate risk is affecting communities. Political and demographic shifts are reshaping the global economy. The capital market has come a long way, but it must continue to evolve to reach new heights in a fast-changing global landscape. Malaysia stands at a crossroad. This master plan is designed to reshape and recalibrate Malaysia's capital market as the core economic and wealth generator. The master plan aligns with national aspirations towards a high-income economy, supporting Malaysia's sustainability agenda and our broader ambition to be a regionally competitive nation. This is an ambitious, whole-of-nation effort. It is built on deep collaboration, delivering high-impact initiatives with our stakeholders.
Ultimately, the success of the Capital Market Master Plan depends on the collective involvement of all stakeholders. This includes mobilizing the support and collaboration of policymakers, government agencies, fellow regulators, as well as domestic and international participants. Together, let us reshape and recalibrate and embark on the next chapter of the Malaysian capital market growth story so we support the nation's transition to a resilient, high-income economy.
Clear, with measurable 5-year outcomes and longer-term aspirations. Our vision is anchored on 4 strategic outcomes. A vibrant capital market, accelerating growth through stronger valuations, new economy sectors, quality listings, and issuances. An inclusive capital market, broadening investor participation and improving business access to market-based financing. A sustainable capital market, mobilizing capital for climate transition, adaptation, resilience, and inclusive social outcomes. Regional advantage, positioning Malaysia as the gateway to regional opportunities and nurturing national champions. The master plan will be guided by Islamic leadership and the principles of Maqasid al-Sharia as our unique global edge, underpinned by regulatory and governance that is globally trusted and future-ready. Investor protection will be reinforced as the market evolves. This is our commitment to a resilient, inclusive, and sustainable capital market. Collaborating for our shared vision, a pledge to the generations ahead. Reshaping and recalibrating for the future.
If you're wondering if you've seen that house before, all consultants come up with a house. So that's from my consultant. Now, I hope the video gives you a sense of Malaysia's ambition. Our recently launched master plan, our plan is to move the market from about 1.4 trillion to about 1.6 trillion, which is about 2 trillion ringgit, and to do this in 5 years. Now, as the video pointed out, there's actually 4 main pillars. I intend to speak more about the first and the fourth. Now, the first thing one has to realize is that regulators can't do this alone. We're very much reliant on the government of the day. And in this respect, the master plan builds on the excellent work our Malaysian government has done to reduce our budget deficit, reduce public subsidies, and at the same time reducing leakages and promoting both FDI and DDI to fund new economic activity. We've also had a fairly stable currency. But this master plan is different. It does not take the orthodox view of just looking at the capital markets. What we tried to do was to actually step out of the Securities Commission and to try and understand what are the problems that the country will be facing in the next 20 years. And the idea behind this plan is to also try to address those challenges. So therefore, it's a very multidisciplinary, cross-sectoral view, and as it says, it's a whole-of-nation effect. Now, the master plan acknowledges the reshaping and recalibration. It's fundamental. And I think you need to understand that just like Turkey, where you've had an average of 5% GDP growth, we too have been achieving that in Malaysia. The unfortunate thing is the capital market is not growing at the same speed. And that's why structurally we have to go back and look and see what can we do. The overall objective is to actually raise the economic ceiling, but also the floor. So let me just explain a little bit more about some of those pillars. So with the global order fracturing as we speak, geoeconomic competition rising, a major concern is the ability to continue attracting global capital flows, not just trade flows. And that's why the 2 pillars that try to address this are market vibrancy and the regional opportunities. So under pillar 1, market vibrancy, the push is for better long-term corporate market valuations, because we essentially need to build up the value of some of these companies, which of course in a way reflects their performance. Like Japan and Korea, we've launched this My Value Up. The Koreans and Japanese have something very similar. But what we also hope to do is to reinvigorate the markets with exchange-traded funds, because we feel that's the way to go. After all, Warren Buffett did say that if you can't figure out what stock to buy an ETF. Now, Malaysia is also blessed with a great pool of savings, which has helped with fundraising and investments. And this serves to not only enhance economic prosperity, but it also attracts investors and project owners. Interestingly, 30% of our market is only retail. 70% are institutional and corporate players. So that means our market pricing is actually a lot more stable and less volatile. Pillar 4, on the other hand, is recognizing that a lot of the foreign money in Malaysia, so 20% in our equities, 13% in our bonds, are very transient. It tends to flow in and out. So what we're trying to do now is to look for long-term sticky capital. And hence now we're looking to discussing with pension funds, regional funds, development funds around the world to see how can we get them to look not just at Malaysia, but ASEAN as an asset class. We do appreciate indexes like the MSCI Emerging Markets Index, but the focus for them is really about exit. You know, is there liquidity, is there free float, and how quickly can I sell and run? That's not really what we're trying to encourage. Much like Turkey, sitting at the confluence of Europe, and I noticed yesterday your finance minister mentioning that in a way you too are a gateway to Europe from this side of the world. We hope to replicate that in Malaysia by making Malaysia the gateway to ASEAN. The plan, however, doesn't just look at making money. Our government, Madani government, actually looks a lot at the unfortunates or the vulnerables. So in Pillar 2, inclusivity, we're focusing on retirements. We'll be a retired or aged nation within 10 to 15 years. And the question is, are the returns that they're getting from their pensions sufficient to keep them going throughout their pension period. Also, we're looking at SMEs because they're part of our pipeline. I gather in Turkey you have about 40 to 50 listings a year. Last year we had 60, but most of them are really SMEs coming into the market. The other theme there, pillar 3, is sustainability. So ASEAN is actually one of the more climate vulnerable part of the world. And while we have plans to do transition and also to, I suppose, have a plan for adaptation, unfortunately, it doesn't come with money. So one of the things we're trying to do here is to figure out how to crowd in private money to essentially solve a government problem. Because if you don't, we'll all be taxed more. So as an example, we have a project in ASEAN called MARS, Mitigation, Adaptation, Resilience, and Sustainable Financing. And the problem statement is most adaptation projects are not bankable. So how do you come up with blended finance using free money, concessional money, and commercial money to pay for these things? So one example is that we're talking now with the various religious authorities about perhaps reusing zakat money for adaptation projects. Also, we've just launched a social exchange. The idea behind this is that charities can come along and do a pitch for money, but eventually it will be for social impact companies and the final stage, communities. So those who are affected by natural disasters have another avenue to raise money. Now let me turn to Islamic finance. Now, I think as mentioned yesterday, the outlook for the Islamic finance is very promising. The same numbers I have, the minister quoted, which is 9.7 trillion by 2029. But yes, it's very small compared to the whole global market. So, having said it's small, we still need to think about how to do it better. So that's why we started thinking about Maqasid al-Sharia as a compass. So if I can quote my Prime Minister, Datuk Sri Anwar, he said this, and I quote, "The ethos of Islamic finance must be rooted in Maqasid Sharia, which emphasizes fairness, risk-sharing, and social well-being. Its true measure of success will never be the size of assets alone, but the lives transformed and the future secured." So that thinking is already embedded in our regulatory architecture. The SE introduced the Maqasid al-Sharia guidance for Malaysian Islamic capital markets in 2023. And from a finance perspective, and you'll see the words up there, there are basically 6 aspirations involving humanity, justice, benevolence, and so on. But these are not just philosophical abstractions. What we're doing now is to translate those thoughts into something that's operational. So we are developing regulations, guidances, training, and also products that actually reflect the Maqasid al-Sharia better. In fact, I think something like 20 of our recent sukuk issuances have declared that they comply with the Maqasid. Another outcome of this framework is that we are revisiting and reassessing the current range of products. Increasingly, we believe that products should be more than a mirror of conventional, but it should also demonstrate elements of halal toyib, wholesomeness, and purpose, and very much in line with the Maqasid. So I recall yesterday, the minister made the same comment, that his wish was that the Islamic finance would come up with more innovative products. So our proposition is to rethink our product offerings and to develop Islamic finance, not by ourselves domestically in Malaysia, but by reaching out to different parts of the Islamic world. So you may have seen me yesterday with a different tie, signing the MOU with the Ibn Khaldun University. Last year, we signed up with Durham University in the UK to do this. And we are seeking other partners within the OIC world to explore how can the Maqasid be operationalized in the capital markets. So if any of you are holidaying in the UK in September, there is a roundtable in Oxford at the OSIS, the Oxford Centre of Islamic Studies. And there'll also be a forum, which Al-Barakah is running for us, at the Inner Temple, home of the Knight Templars, in London itself. Well, I think it's quite apt, isn't it? They too won Jerusalem, but they kind of gave up 1,400 years ago. So basically, we want to take the discourse further. Another example of how we can further the agenda comes back to looking at Turkey. As a permanent host of COMCC, the Organization of Islamic Cooperation, its principal body for economic and commercial cooperation, I think Turkey is in a uniquely strategic position to influence the broader Islamic economic system and should be looking to what we're doing now with the Maqasid. Beyond this institutional role, our host has demonstrated, Turkey, steadfast commitment to participation financing, supported by regulatory reforms led by the Capital Markets Board, and also some of the ideas yesterday we heard from the Finance Minister. So these are developments that we in Malaysia follow with great interest. And we believe there are areas of mutual benefit where we can learn from each other, and SC Malaysia is willing to explore. After all, as my Prime Minister mentioned, scale alone will not be enough. The depth of our belief, experiences, and quality of our regulatory environment will actually be quite decisive. Only by collectively strengthening the capacity of the ecosystem can we ensure that finance is truly serving the underlying as well as the higher purpose. To conclude, let me share a simple idea for consideration. Given the impact of climate change and the need to build large infrastructure projects for consistent water supplies, river flooding control, coastal erosion, and even seawalls, they're very expensive. All this will need significant sums of money for climate adaptation and mitigation. So we were going to explore what if the OIC member nations and ASEAN were to contribute towards a shared pool of patient principal capital, maybe structured as a takaful, which is designed to absorb the first loss risk of climate and development projects across jurisdictions. We're thinking it could be based in Singapore, the takaful could be based in US dollars, but it will be managed by obviously the countries that contribute money to it. But the idea of having such a fund is that many of the sovereign jurisdictions do not have the capacity to guarantee these kind of projects. Hence why we think, in fact, we even have a name for it. We call it the Guardian Takaful, why it's necessary. So I'll leave you with that thought. Before I conclude, I would like to thank the organizers, the Al-Baqarah Forum for Islamic Economy, and its partners for this opportunity to share my thoughts on our Malaysian master plan, and also how we can collectively help each other in order to improve the Islamic finance ecosystem. To borrow from the master plan's tagline, let us reshape and recalibrate together. Thank you.
Thank you, Dato Muhammad Faiz Azmi, for your insights. Much appreciated. Ladies and gentlemen, we now move on to what promises, to be one of the most important discussions of the summit. The effectiveness of any economic system depends not only on how capital is created, but also on how it flows across institutions, sectors, and borders. This challenge is particularly significant for central banks, monetary authorities, and ministries tasked with balancing growth, liquidity, resilience, and inclusion while navigating an increasingly complex global economic landscape. Our opening panel of the day is titled Re-Engineering Capital Flows: An Islamic Framework for Comprehensive Macro-Micro Economic Integration. Moderating this distinguished panel is His Excellency Dr. Mahmoud Muhyiddin, the United Nations Special Envoy on Financing Sustainable Development. If he can join me here on the stage, I'd appreciate it. Also with us today is His Excellency Dr. Fatih Karahan, the Governor of the Central Bank of Turkey. His Excellency Mr. Abdul Rashid Ghafoor, the Governor of the Bank Negara Malaysia. And His Excellency Mr. Yahya Jawdat Hafiz Shunnar, the Governor of the Palestine Monetary Authority. Over to you.
Right. Thank you so much. Assalamu alaikum wa rahmatullah. Bismillah ar-Rahman ar-Rahim. It's a great pleasure to have this task. It's a big one. It's a challenging one. If you check the background information for this session, we're basically going to try to solve the problems of the world of not just finance, monetary policy, financial stability, and linking that all to sustainable development, that we are going to do that in the kind of environment that we are very much aware of, is where uncertainty is being frequently referred to as the kind of environment that policymakers, including governors of the central bank, of the central banks, are working within. I'll start by the conclusion, and I was very much happy to come in this session after the excellent introductory remarks and the keynote speech by His Excellency Dr. Azmi, because we'll keep referring to some of the major concepts that he alluded to. But let me start by the conclusion. The objective of this session, that after the time we'll be spending here, is to answer some specific big questions. How central banks and monetary authorities can guide capital towards real sector development. It's not finance for finance. It's not just about funding. It's basically funding for something that's much more substantive. You link it to maqasid al-sharia, you link it to sustainable development goals, you link it to something that has a meaning and substance. So there is no finance for finance in the context of our discussion today. And then another tricky part, how can you do that while the system is close to be compliant to Sharia when it comes to liquidity and monetary tools? And the third point, how capital flows can be governed to reduce volatility and speculation. Then, if you sort out all of these simple questions, we need to deal with another one, how finance, Islamic finance in particular, serve small and medium enterprises, households, infrastructure, trade, food security, and job creation. If you are lost, you can refer to the Sustainable Development Goals and their objectives, because they cover all of these aspects in different ways. How Islamic finance can support sustainable development goals in a way that will not really solve problems of development by creating a crisis in debt. And of course, if you have debt in kind of unsustainable manner, you cannot really achieve sustainability of development. Then how institutional cooperation between different regulators can support the reduction of fragmentation and deepen cross-border Islamic finance markets. And if we finish all of that, how to build an integrated capital and cash flow ecosystem. So it's great to have this discussion here in this very vibrant city, known for centuries to be the ultimate connectors of people, ideas, and civilization, the vibrant city of Istanbul, hosted here in a country that's known for its hospitality, its ways in dealing with major issues of concern, not just within the country, but beyond, trying to find solutions, not to complain about problems. The Republic of Turkey, I'm very much grateful to the hospitality of the people of Turkey, and of course, the government of Turkey, led by His Excellency President Recep Tayyip Erdogan. And of course, there is a great deal of collaboration here between Al Baraka Group, Al Baraka Forum, and all of the partners. So to help us solving these basic questions, we have three distinguished speakers with great background. I will not go through that, otherwise we'll be just spending the time going through their history of achievements, each one of them with great credentials. But three governors of the Central Bank of Turkey, the Central Bank of Malaysia, and the Central Bank of Palestine will give them the opportunity to go through first, and the way that we conducted. We'll start by the presentations. Some of the governors are ready with PowerPoint presentation. They will share it with us. Others will come through direct verbal introductions. And then I have in a separate part of the session some well-prepared questions by the organizers, and then we'll open it for discussion. Before coming here, we just got the update, and I shared something about it. When we are trying to link money, finance, and supporting of funding for development, the main metric of development had been GDP, the gross domestic product. Now this being challenged for many years. I'm happy that at the UN, there is a report that came out just a few weeks ago. It's called Counting What Counts, trying to establish a dashboard of indicators that covers many of the things that I just mentioned now. When we are trying to have matters related to finance linked to substance, it's not just about linking them to GDP. It's about linking them to areas of inclusiveness, stability, matters related to sustainability, governance in institutions. I'll come back to that in the questions after getting the presentations done. So we'll start by His Excellency Dr. Fatih Karahan, the Governor of the Central Bank of the Republic of Turkey, followed by His Excellency Dato Siri Abdul Rashid Ghafour, the Governor of the Bank Negara, Malaysia, and after that, His Excellency Mr. Yahya Jawdat Hafiz Hunar, the Governor of the Palestine Monetary Authority. Excellency Governor, the floor is yours.
Well, thank you. First of all, thanks for this great introduction and for the kind words. It's really an honor and privilege for me to be here alongside such great company, distinguished governors and friends. I figured I'll make some of my regards. It's best to do them with a short presentation. And I was thinking about what some of the key questions are for me, so I've arranged my talk around those questions.
Yep.
So today I'm going to, at least in this part, focus on two questions. One is more of a macro question on capital formation, basically what determines how effectively capital or wealth is transformed into productive activity, into investment, into long-term value, and then shared prosperity, as opposed to it remaining idle or underutilized. So that's one topic I want to touch on. And the second one is a bit more micro and a bit more active, meaning how can central banks and more generally, the industry of financial institutions and financial intermediation strengthen this to support capital formation and productivity growth. So I'll answer these two questions in turn in the time that I have. So let's start with the first one. Okay, so I figured it's useful to look at why we care about capital. Why is it that we care about investment? Why do we care so much about the strength of financial intermediation and how good it is in transforming wealth into capital? It's just a very simple look at the data, shows you that countries with more capital are more productive. So here, I'm showing you, of course, per worker, as different countries have different levels of capital, and it turns out that those countries, the ones with higher level of capital, tend to produce more within a unit of time, and so that results in prosperity as a result. So that's why we want to channel funds into productive investment. Now here, I think it's very useful to set the stage for this panel, but also I think overall the themes of this conference,
Yep.
to distinguish between wealth and capital. Usually we talk about them as if they're the same thing, they're interchangeable, but they really are not. So I want to offer a conceptual framework for thinking about some of those differences and then give some examples. So what is wealth? Wealth is basically the stock of assets that stores value. And why do we keep wealth? What's its purpose? Well, it offers preservation of value. offers security, and then it provides value for consumption in the future. So that's why there's this thing called wealth. Capital, usually we think it's similar, but it's really different. Capital is a special form of wealth which is mobilized into productive use, and it's traditionally done so by combining it with labor and or technology. So the purpose here is what we care about, is to produce more output, is to generate more income and more prosperity, and also to generate innovation going forward. So this distinction is important. Why is it important? Because societies can become wealthier, but that can happen sometimes without a corresponding increase in productive capacity, in innovation, or in employment. But that's not the type of wealth that we want necessarily. What we want is to transform those funds into productive capacity. So really the central challenge for us, for any economist, is not really wealth accumulation on its own, but the transformation of that wealth into productive capital. That's the central question. And here, we talk capital, and usually people have in mind, machinery, factories, and so on. But capital is really a lot more broader. There is, of course, physical capital, which is what a lot of people tend to think about when we talk about capital. The buildings, the machinery, the factories, the infrastructure, and all that. But there's also financial capital. There's human capital, is equally important. It includes the skills that people have, even the health that we have, because it makes us more productive if we are healthy, and all the knowledge that we have. There's also intellectual capital that's becoming more and more important. That includes all the different technology that we have with the patents that come with it and so on. The social capital, for a lot of businesses, a lot of their capital is not the machinery they have, but the customers they have and the trust that they have. So it's also a different form of capital. And then there's natural capital, which is, the land, the water, the natural resources, oil, gas, and all that is forms of natural capital. So the bottom line, really, all I want to say with this rather long introduction is that all capital is wealth, but not all wealth is capital. It's a very important distinction. So just want to if you want some examples, I've listed some of them here. For us, for example, what I want to emphasize here is if you have gold under the mattress, that is wealth, yes, has market value, but it's not capital. But if you have infrastructure, that's productive. Okay, so the key, as I said, is to transform this wealth first to make sure that we get wealthier, to incentivize savings, but then also to make sure that it leads to productive activity. And so here, a number of factors that stand out for this channel to work. There's a number of these things. I won't have time to go into all of them, but I will argue that price stability is key. So what central banks are doing, if they do their job right, it's also very important for investment climate. Financial stability, because it leads to trust in the financial system, makes the financial intermediation more effective. Then, of course, the overall investment environment and the confidence that stakeholders have in the system. So all of that is important to make sure that people would like to save, they would like to generate wealth, and they're able to generate wealth, but also that wealth is then transformed into productive activity and that we get growth and prosperity. So I want to show, because I'm a central banker, I'm going to talk mostly about price stability and how and why that is very critical for these links to work. And best is explained with an example, and I think the Turkish example is a really good one. So what I want to do is to compare different periods of time. We've had high inflation episodes in the past, and then we've had relative price stability as well. So I want to compare these different episodes. So I'm going to compare the period of the 90s, which is about 15 years or so, where we had high inflation. How high? Was around 70% also on average. Then we've had price stability, relatively speaking. How? Was a lot of reforms that went into that. tight fiscal policy and tight monetary policy. So we've had inflation averaging single digits, but for most of that period, it's actually much closer to the central bank target of 5%, even though for some periods it tended to be higher. One thing that I want to emphasize here is that this period between 24 and 2019 is a period of tight policy, both fiscal and monetary. So you would think because money is expensive, lira is not cheap, that investment would be weak. But actually, if you look at the data, at least in the Turkish economy, you compare these two periods, how strong investment was in terms of investment growth, real investment growth per year, the latter period with price stability, with tight monetary policy, with tight fiscal policy, we've witnessed much stronger investment demand during that period. So in period of high inflation, investment growth was around 5%, then it went to almost 8% for about 15 years. Why? Because low inflation means a more predictable environment. You can project your costs. It's easier to do business. It's less volatility in the markets, less volatility in output, so it's easier to do business. But also, there's long-term financing options. If financial, actors in the financial sector, they see inflation is low and is going to remain low, then they can offer long-term products, long-term financing at much lower rates. And that means actually you get more investment, which is exactly what happened. Now we got back after COVID, as the rest of the world did, back to an environment with higher inflation. That period was also, relatively speaking, a period of cheap lira and abundance of that as well. So let's see what happened to the investment climate and to investment in that period. Well, guess what? Actually, as opposed to it increasing further, which is what some of you might expect, because lira is cheap, so why not take credit and invest in long-term projects? Actually, what we saw is the opposite of that, because people saw inflation coming, and so the investment climate deteriorated. Now, we've been tightening, or we have a tight fiscal and tight monetary policy again, and as a result, we were able to reduce inflation a little bit. So I'm going to compare it for year-end for 2025. We ended the year with just shy of 31% of unemployment. Now it's a little bit higher because of the war and its ramifications. But what happened over this period is actually investment is gaining hold again. It's getting stronger. Again, the key determinant here is not really only the rates that are available to people who want to borrow, but also the overall, predictability and stability which you get in a lower inflation environment. So really, price stability is really key for channeling funds into investment, and we're seeing some of that picking up as a result of the efforts that we're doing. And as a result of that, well, we don't just care investment for investment's purposes. We care about investment because we care about productivity. Ultimately, we want to have a more productive economy so that we have prosperity. And if you look at this output per worker, which is a measure of productivity, it's been picking up. And related to that, of course, is R&D expenditures are rising as well. So all of this is basically a story in which the productive capacity of the economy is going to expand as a result of the improvement in macroeconomic stability. Now, so let me now turn to the second part of the question. The first part is more about, how the macro indicators are important for channeling savings into wealth and then into capital. The second one is more about financial intermediation. And here I'm going to emphasize a couple of things. So one thing, and this leads me back to connect to the theme of this conference, which is Islamic finance, Islamic economy. And here, really, there's a lot of value that this sector offers. And for us, at least first and foremost, it's about financial inclusion. Mm-hmm. There's a lot of, there's a good chunk of the economy who have a preference for not taking part in traditional banking sector. And so in the absence of alternatives, they would be outside the banking system, outside the financial system, so their wealth would not be channeled into productive economy. But here, participation finance is basically increasing inclusion. How do we see that? There's a bunch of things that I could show you, but just to show you one, participation finance basically is disproportionately represented in SME lending. So a lot of the SMEs who would maybe not get credit and run their business using traditional banking instruments are using participation finance instruments. And so that is broadening financial inclusion, and it's mobilizing all that wealth in those sectors of the economy, those untapped savings, into productive use through financial intermediation. As a result of that, actually, steadily, participation finance has been increasing in Turkey. You look at the asset share of participation finance that increased. The numbers are not very high, but they increased from 4.5% or so in early 2010s to above 9% at the moment. And as a result of that, over this process, the number of participation finance institutions has increased, and there's two new institutions that got the license, but they will start their operations. So it is, I wouldn't say they're booming, but it's an industry that is steadily and robustly growing. And as a result of that, actually, you see also participation banks, their loan growth is stronger compared to deposit banks, which is contributing to their gaining market share in the finance sector. Lastly, I want to just touch upon some of the things that we are doing proactively, because the two business models are very different. The traditional banking sector, the way they do business, of course, is very different. And the participation finance, they have a different way of doing business. And the central bank tools, in terms of liquidity management and others, they tend to be designed they're more geared towards the traditional banking industry. But in this period, they need to be tailored to also serve the participation finance institutions, which is what we've been trying to do for the past 2 years. So just a couple of things I want to emphasize, which contributed to the success of the participation finance in Turkey the last couple of years. First, we've started to introduce compatible liquidity management tools. There's a lot of excess liquidity, and the way they manage the liquidity, the tools that we offer have to be compatible with their priorities. So we started offering some compatible liquidity management tools. There's a lot more that we need to do, and we're working on that. The second is we have in our policy is not just the monetary policy rate. We complement our monetary policy using macroprudential measures, just like many other central banks do these days. And these measures have to be tailored according to participation financial institutions as well, because they have a very different model, they have a different customer base, so that calls for a specific look, a careful look or calibration of these measures. So we've started to do that these past 2 years. And then the last one, the CBRT, we have some credit programs for exporters and for investment, for long-term investment that we finance, the banks intermediate it. So we've structured some of them so that the participation finance institutions can also offer that to their customers, and that also help them, grab some market share in the market. I'll end my remarks here. Thank you.
Right. Thank you so much. Please join me in thanking His Excellency the Governor for such a comprehensive and deep analytic way of handling 3 big questions, from the macro to how to handle matters at the micro level, and then the specific toolkit for Turkey that could really be of benefit as well for other countries, especially with the emphasis on productive capital, SMEs, and growth of productivity. You made a very interesting distinction as well, not just between wealth and capital, but between the different forms of capital. And this is a very good preparation, not just for Turkey, but for all members of the UN system who are going to be, hopefully soon, embracing the new system of measuring the indicators of performance beyond GDP. GDP is going to be there, it's going to be better in terms of accuracy, but there is going to be a dashboard. And of that dashboard, Mr. Governor and Mr. Governors, there are all kinds of capital that you mentioned are going to be in that dashboard. It's like you drive the car, you are not going just to have one barometer or one indicator. So one of them is sustainability and inclusion. And there you emphasized fiscal capital, productive capital, material capital, and there is the human capital as well, and the institutional capital. And you added, actually the UN only spoke about 5 kinds of capital. You spoke as well about financial capital coming from your background. So it seems, I wouldn't speculate, but Turkey is already aware of these types of capital and how to measure them down the road. We'll come back with some questions, especially linking not just capital to wealth, but as you mentioned, Excellency, when you mentioned that big thing, as I was a Minister of Investment, and I was wishing that there could be a ministry for savings, because you cannot do investment without the base of, coming from Egypt, the base of the pyramid is saving. If you don't have savings at home, domestic, or mobilized nationally, you are going to be borrowing abroad, or you'll be relying on FDI, which is becoming more vulnerable than ever before. This is a great introduction, not just to the session, but linking it to the discussion that we had during the last 2 days as well. Thank you so much, Governor, for that. So let me move from Turkey with a great example, a G20 country with, I would say, through the G20 and because of the regional integration, has more to do in its policies than within the boundaries of Turkey. So what happens in Turkey is differently important for Turkey and the Turkish people, but important as well through elements of trade, investment, and influence, and your important role in the international institutions. Now we move to another country in in Asia, Southeast Asia, and Chairman Azmi mentioned a couple of times your role in the ASEAN. Last year, you hosted very successful summit for the ASEAN. So here again, matters related to Malaysia are very important for us as members of the OIC, with many links between the different members as well through trade, investment, knowledge sharing, but through your leadership role internationally and through the regional work in the ASEAN. So no better than His Excellency the Governor of the Bank Negara, Malaysia, His Excellency Dato Sri Abdul Rashid Ghafoor, to go through the 7 questions, but I would really appreciate if you can really give some hints beyond Malaysia to the ASEAN neighborhood and beyond.
Thank you.
Excellency.
Thank you, Dr. Mahmoud. And first of all, let me congratulate and thank the organizer, Baraka Forum, for the very well curated and very well organized conference. I'd like to thank my fellow panelists, Dr. Fateh and Dr. Yahya as well. I think thank you for sharing in terms of the underlying importance with regard to stability. So that's where I think the perspective of central bankers comes in. I think as a steward of stability and also in terms of architect of resilience in the face of developing Islamic economy. I think let me just touch on the problem statement before I think we go into the areas where you mentioned just now with regard to our role in the region, especially when we chair ASEAN last year. Rule of capital, linking it back to the theme of the conference in terms of rethinking capital flows. What's the problem statement that we see right now? I think this is something that has been addressed yesterday quite extensively, but I want to just reiterate the point. Number one, in terms of the capital misallocation. Second, in terms of it's not really supporting the real economy. So why is it so? And what do we do in terms of addressing this problem statement? I'll then touch a little bit in terms of role of Islamic finance in the context of Malaysia and how do we push Islamic finance in terms of preparing the infrastructure and also in terms of the products that supports the achievement that we want to see achieved or the outcome in terms of supporting the real economy. But before that, let me just share some context, I think, just to build on what my colleague Dr. Faiz shared just now in terms of the size of capital market, not just globally, but also in the case of Malaysia. But if you look in terms of the banking sector in Malaysia, the financing of Islamic finance represents about 48% of financing at this point of time. And this has grown over a period of 40 years since we have our first Islamic bank in 1983. But actually, Islamic finance in Malaysia started even much earlier than that. It's with the first Tabung Haji Fund, the pilgrimage fund. Second, from the deposits accumulation, it's about 43.6% of market share at this point of time. And the funds asset is about 14%, and in terms of this is for takaful, and for the net contribution for takaful is about 24%. So that's the context in terms of the size of Islamic finance in Malaysia. Let me just touch in terms of still at the global level with regard to the problem statement. I think there's three issues. First, in terms of while we know that global capital is abundant, but it may not always be linked to productive economy. So this was touched mainly yesterday by the minister and also by Brother Iqbal Khan as well. If you look in terms of the global financial asset expanded to about 600 trillion US dollar. Yet the study by McKinsey Research and also by the IMF staff report highlights that about only 30% of those funds reflect new productive investments, while the remainder actually largely stems from financial asset revaluation. Second is that capital is also not fully reaching its purpose. There's 700 million people remain in poverty. SDG financing gaps exceed 4 trillion US dollar annually, and the funding gap is more acute across the OIC countries with the large structural financing gaps. For example, if you look in terms of the infrastructure funding gaps projected around $2.7 trillion needed between 2016 to 2040. And particularly with road construction and also basic utilities, and also partly in terms of sustainable developments. Second, in terms of there's more than 1 trillion US dollar required by 2050 to meet climate mitigation and adaptation alone. So that's a huge sum. And why capital is misallocated? Number one is in terms of capital concentrated in safe haven advanced economies. I think this was touched by His Excellency Minister yesterday. I think we do see that this capital are more concentrated in the advanced economy and it's a safe haven. And risk perception penalizes emerging markets. And regardless of the underlying fundamentals that in the emerging market economy has. And second is that the financialization are also not anchored on real economic growth. It's more in terms of financialization itself. And the short-termism does shape allocation decisions and favoring liquidity, speed, and exit over long-term value creation. And it's supported by the research work by both McKinsey and also IMF staff paper. So what do we do about that? I think, let me just touch, maybe to me, I would say that finance must be anchored in productive economy. So that must be the main pillar of financing, the purpose of financing. Three things I want to touch here. First is that, number one, we need to strengthen the link to productive economy. And how do we do that? Capital flows should be anchored to long-term value creation and nation-building outcomes. Policy priority should encourage finance linked to tangible economic activities, ensuring funds translate into output, jobs, and also productivity gains. For example, in terms of how do we develop supply chain for strategic sectors, like in the case of Malaysia, semiconductors, for example, digital infrastructure, and also food security. Second, in terms of how do we also promote the halal value chain across the OIC market. So that's where financing needs to go into. And third is that capital must be anchored in assets and economic activities, not just balance sheet. And this further strengthens the productive investment while also reducing speculative and short-term capital flows. The second element is that direct capital to finance more complex economic activities. As we grow to become a more complex economic framework, this is something that we need. We need to shift from value extraction towards value creation. How do we do that? I think this involves sophisticated financing needs And innovation-driven sectors often face financing gaps due to the highly uncertainty and also the longer gestation periods. So this is where Islamic finance, with the profit-sharing mechanism and approach, can play a role in terms of providing financing for this sector. Yet, while we know that the requirement for this more complex activities is very high, but yet what we observe is the system remains tilted towards low risk. More of collateralized based lending and lending innovative industries structurally still unfunded. And that's where I believe that Islamic finance does provide the embedded risk sharing and asset linkages, and they are certainly better suited for the longer investment horizon, dynamic cash flows, and entrepreneur-led growth. For example, based on equity-based partnership, musyarakah, mudarabah, I think align returns with performance. Second, in terms of the blended structure that incorporates social capital like the zakat, wakaf, we discussed a lot about wakaf yesterday. This also helps to de-risk early stage financing. I'll touch a bit more on this later on when I share about the experience in Malaysia. How do we start to develop zakat-based financing, a blended finance approach that incorporates zakat, grants, and also microfinancing, and with some kind of like structured training and capacity building for the small and medium-sized enterprises. The third element that I want to touch in terms of to embed sustainable outcomes into finance intermediation. So this is very critical. Because the investor appetite for impact-aligned investments is actually rising quite rapidly now. And the challenge is not merely capital availability, but the challenge is the infrastructure to channel the capital effectively. So we need to address that. Therefore, the policy focus should shift towards enabling infrastructure that aligns capital with outcomes. And how do we do this? We need to have clear transition goals on a sustainable finance framework. We need to have robust impact measurement and disclosure standards. We need to have a catalytic platforms to crowd in private capital. And fourth, we need cross-border interoperability, including Islamic finance connectivity. So let me touch a bit in terms of what we do when we chair ASEAN last year. We know there's a very huge financing needs for sustainability, for transition, for adaptation. So that's where we try to bring funds into the region in a blended finance approach, because we know banks can't finance this alone. So we need to work with philanthropic to get some kind of like early financing. We need to work with grants, for example, concessional grants from the the World Bank and the rest. And of course, the banks can also come in. And finally, what's important in terms of the capacity building to guide countries to transition. So that's what I think we did. So one of the initiatives that we championed during the year was the ASEAN Power Grid, linking the power grid within ASEAN so that countries, we can share the energy, the renewable energies among countries. And we can then pass through from, for example, from Vietnam into Malaysia, into Singapore, and also into the East Malaysia itself. And financing for this is very important. And so we had a sessions in terms of mobilizing all the investors, philanthropists, and also others to come into Malaysia and identify what are the projects that we have and how do we provide financing for this. And alhamdulillah, we have been able to raise at least 1/3 of the financing needs for the ASEAN Power Grid during the year itself. And there's more coming into this engagement. Let me just touch a little bit, I think, Dr. Mahmood, in terms of, I think, what do we do in the case of Malaysia? Talking about productive financing, talking about impact financing. There are three things I would like to highlight in terms of the initiative that we have undertaken, we have started. One is in terms of, we call this product the I Tekad product. I Tekad meaning I am determined. And we started this during the pandemic with a very small test bed, about 40 participants, where we provided with zakat to the asnaf. And we complement this with small microfinancing loans from the banks. And third, we supported them with a structured training from the training provider. So they not only provide funding, but also training in terms of how do you manage your finances, and how do you do your businesses, and how do you even market your products. So what we have seen is that starting from 40 participants, now it has grown to 14,000 participants. And we have seen a transition that they were recipient of zakat. Now they are contributor to zakat. And they have even created jobs for their, in their village, for their colleagues and also families. And they have also been able to export their products thanks to the very strong payment linkages that we have in ASEAN. They were able to sell their products, for example, made in Malaysia, in one of the villages in Malaysia, in Indonesia, in Thailand and the rest, and get instant payment immediately. So these are the kind of things that can transform the well-being of a person. So that's one product that I would like to share. Second is that to catalyze these risk-sharing financing solutions, we introduce a product called iCita. iCita is ambition. That's where we want to really move towards risk sharing, where the government provides some grants, and we complement this with financing from the Islamic financing institutions, both Musyarakah and Mudarabah, to supplement the critical economic sectors. So this has helped as well. Again, this is a more of a blended government funding approach as well that provides some de-risking. And so what happened is that you were able to lower the financing rate, the overall financing rate for these purposes. And the third, in terms of greening halal business, so this is where we implemented in collaboration with the World Bank and the Islamic Development Bank. And this reflects Malaysia's broader effort to integrate global halal value chain while at the same time advancing climate objective. And it supports halal SMEs in adopting greener and more sustainable business practices through green upskilling, ESG reporting tools, transition financing, and impact monitoring. Maybe I'll stop here. I'll touch later on in terms of how do we also encourage or enhance regional integration through Islamic finance. I'll do it later at the second stage. Thank you.
Thank you so much, Excellency Governor, and please again join me in thanking the Governor for the excellent coverage of topics. I don't know why when you're talking, you reminded me of the three magnificent bridges of Istanbul. The first one, when we're trying to connect finance, and then it's not just about the financial street or the Wall Street in the case of the international markets and New York, but the main street when you talked about the markets and the goods and the services and how can we get the finance linked to these goods and services. And then embedded in the discussion is basically about the welfare of the people. Right. So you have those three bridges of the finance, of the Wall Street, of the main street, right, and then the people and their welfare and their happiness or rida about what's really happening. So, and here there are two approaches to it. And it's good that you mentioned, Excellency, the term of financialization. One professor of mine, and Professor Mehmet Asutai, who's here, Malcolm Sawyer, who is distinguished professor at York and then Leeds. He spent a lot of time on this issue of financialization, but I think the matter here is not like to have waste and then cleaning up. It's from the origin of funding. You need to make this kind of establishment between finance and the substance of finance, of the underlying asset. And then you mentioned many other areas that will be coming back to, especially in areas related to the regional role and the international role. And I know when we are stuck, especially in areas related to innovation of Islamic finance and looking for standards, and even outside Malaysia, they would go and check what our Malaysian brothers have been doing in that particular area, rather than reinventing wheels. And it's good that I see it's not just politics, good chemistry between the two ultimate regulators of banks and the capital markets. But there is something strongly happening because the tensions in the past have been between bank and non-bank financial institutions. But now finance is happening not just through banks, not through the non-bank as financial intermediaries as well, but beyond that in the terms of technology companies and their applications. We'll come back to these questions after listening to His Excellency Mr. Yahya Jawdat Hafiz Chunar, the Governor of the Palestinian Monetary Authority, or the Palestine Monetary Authority. It's a great honor, Excellency, to have you with us here. Every governor in the world of central banking have a challenge, but when it comes to you, multiple compounded challenges are there as well when you are conducting business, maintaining the main functions of and the objectives of the monetary authority in very exceptional circumstances that we pray to Allah subhanahu wa ta'ala to give us all the strength of steadfastness, but to wait for the day that there will be ease after the great hardship that our brothers in Palestine have been seeing for many decades. Governor.
Thank you so much, Dr. Muhyiddin. It's an honor and a great honor to be with you. We had this very interesting session this morning. Dr. Karahan hosted us, me and Dr. Abdul Rashid, and it was on a different league. We were talking about totally the exceptions that Palestine is going through, but this session is not about that. We're going to funnel it down. We're going to talk broadly, and then we're going to funnel it down. I will need the remote to transition. Thank you so much. So allow me first to express my sincere appreciation to the organizers of the Al Baraka Forum and the distinguished forum, and to the all fellow governors, ministers, policymakers, scholars, and financial leaders participating in this very important discussion. We gather today, Dr. Muhyiddin, at a very particularly consequential moment for a global economy. Across many regions, we are witnessing growing economic fragmentation, persistent inflationary pressures, heightened financial volatility, geopolitical uncertainty, and development gaps. At the same time, confidence in the existing financial structure is being increasingly tested. Many economies today face a structural tension. Global liquidity remains abundant, yet productive sectors remain underfinanced. Financial markets continue to expand, yet inequality deepens. Capital moves faster than before, yet development outcomes remain uneven and fragile. These realities underscore fundamental concerns. Whether current capital flows are truly serving the real economy, and whether financial systems are sufficiently aligned with long-term development, stability, and shared prosperity. It is within the context of Islamic finance merits renewed attention, not merely as a niche segment of global finance, but practical framework for resilience, inclusion, ethical growth, and sustainable economic integration.
Yep.
One of the defining features of the contemporary global financial system is the growing disconnect between finance and productive economic activity. Over recent decades, financial systems have become increasingly efficient at moving capital rapidly across borders, yet speed and volume alone do not necessarily generate development. In many cases, the structure of global capital flows rewards speculative activity over productive investment, while short-term financial incentives frequently dominate economic priorities. The core imbalance creates capital movements, impose emerging and development economies to heightened volatility. Sudden inflows can fuel asset inflation and excessive risk-taking, while sudden reversals can destabilize banking systems and constrain domestic policy space. Second, financial resources are often disconnected from real economic production, with large volumes circulating in financial markets rather than reaching agriculture, manufacturing, infrastructure, innovation, and employment generation sectors. Third, small and medium-sized enterprises, the backbone of most economies, remain chronologically underserved as financial systems increasingly favor collateral-based lending and short-term returns. The issue, therefore, is not shortage of capital. It is the direction of capital flows, the logic of allocation, and whether they are contribute to real economic value creation. Islamic finance offers an alternative framework precisely because it seeks to reconnect finance with productive economic activity. At its core, Islamic finance is not simply about prohibiting interests. It is about redefining relationship between capital risk and real economic value creation. Its first principle is the close linkage between finance and real economy. Financial transactions are anchored in tangible assets, productive activity, or identifiable economic value. Instruments such as musharaka, mudaraba, ijara, and murabaha are mechanisms that directly connect capital to production and investment. The second principle is equitable risk sharing. Rather than transferring risk entirely to one party, Islamic finance distributes responsibility more fairly, strengthening investment discipline and improving project outcomes. The third principle is the avoidance of excessive uncertainty and speculative excess, ensuring that financial activity remains anchored in real economic substance. Equally important is its social dimension. Instruments such as zakah, awqaf, and qard hasan embed inclusion and solidarity into the financial system, an economic necessity in the world marked by widening inequality. One of the defining challenges of contemporary policy making is the widening gap between macroeconomics indicators and real economic conditions. Strong reserves, stable inflation, and positive growth figures are important, but they do not automatically translate into inclusive development. The real test of economic policy is whether it supports productive sectors, generates opportunity, and improves livelihoods. This requires stronger integration between monetary policy, fiscal policy, financial regulations, and development objectives. Central banks and supervisory authorities must safeguard stability while actively enabling credit and liquidity flows toward SMEs, agriculture, manufacturing, infrastructure, renewable energy, and digital economy. Within this framework, Islamic finance offers practical tools to strengthen transmission mechanism, including sukuk market, Islamic microfinance, and participation-based financing. Open capital markets create opportunities for investment and growth, but also they require a safeguard that preserve financial stability and economic sovereignty. Capital flows must support long-term productive development, not short-term speculative volatility. This requires robust prudential regulation, macro-prudential supervision, liquidity safeguards, and strong coordination between monetary and fiscal authorities. Within the same finance ecosystem, there is a significant potential to deepen regional cooperation through liquidity mechanism, Islamic financial safety nets, harmonized regulatory standards, and coordinated Sharia governance framework. Fragmentation in standards remain one of the main barriers to scaling Islamic finance globally. Greater convergence would strengthen investor confidence, market depth, and cross-border efficiency. In the recent years demonstrated the fragility of parts of the global financial system through banking stress, inflation shocks, supply chain disruptions, sovereign debt pressures, and geopolitical instability. These developments reaffirm the resilience cannot be secondary to efficiency. A key lesson is the importance of the financial system anchored in real economic assets. Islamic banking institutions in several jurisdictions have demonstrated relative resilience supported by lower leverage, stronger asset linkage, and reduced exposure to speculative instruments. This does not eliminate risk, however. It suggests that prudently structured asset-backed financial system may offer greater and long-term stability. Looking ahead, there is a need to further develop Islamic liquidity instruments, Sharia-compliant stabilization tools, and cross-border crisis mechanisms. Let me talk a bit about the Palestinian case here. We, as a central bank, without a national currency, although it's very interesting, we run 4 different currencies, none of them is our own currency. We spoke about it this morning. And under significant structural constraints.
And the 4 currencies are?
They are US dollar, Jordanian dinar, Israeli shekel, and euro. And you find them in any ATM machine in Palestine, wherever you go. Yet we have abundance of shekel now, 70 billion shekels. We're trying to sell it to one of the countries at a discount. So if anybody's interested, let me know. Yet adversity has accelerated innovation. Digital payment system, including e-Sadad, iBuraq. e-Sadad is a billing system. iBuraq is an instant payment system. This all was developed by us. Were expanded to ensure continuity of physical services under extreme conditions. Let me tell you, there is no cash in Gaza. Without these systems, the iBuraq and the e-Sadad and all that, Gaza would have stopped. There would just be no life the very first day of the war back in October 2023. So with the introduction of these technologies, we managed to keep Gaza alive until today. And of course, the other side is not very happy about that. There was an Istidama Plus that we started back in COVID, during the COVID time, about $300 million. It's increased now to $700 million. This is supporting the SMEs and in different, whether it's a clean energy or employment or healthcare or agriculture and others. Additional external resources have expanded to that, and we are putting now extra one. In parallel to that, the Islamic finance regulation was strengthened through higher Sharia Supervisory Board and the adoption of the AYOFI standards. This experience reinforces fundamental lesson, principle, and in most of the time crisis, linking finance to real economy remains the foundation of resilience and recovery. I'll stop right here. I guess my ending message would be, if we succeed in re-engineering the capital flows around these principles, we will do more around the improve efficiently, we will strengthen economies, expand inclusion, and build a more resilient and sustainable global financial system. Thank you.
Right. Thank you so much, Excellency. It's a wonderful tour. You started by the very global assessment. I think you gave a free of charge, concise summary of the recent reports, the economic outlook of the IMF, the global economic prospects of the World Bank, and the latest OECD report on the state of the economy, and the forthcoming report of the Islamic Development Bank as well, because you summarize that kind of global macro environment with its challenges, uncertainty, lower growth, and you mentioned extreme uncertainty. A former governor of the Central Bank of England, the Bank of England, would call it radical uncertainty as well, in which you don't know exactly the boundaries at all. It's beyond speculation. And then you gave us good examples of what's happening, and of course the use of technology in a very unique way to make the payment system efficient under abnormal circumstances. All of you did a fantastic job as well in raising this issue of challenge. Finance is there, but where is the impact? Where are the issues related to the inclusiveness? And you see that globally, and this issue about connectivity between finance, real market, underlying asset is a big thing. We know that the global financial assets today exceed 500 trillion. This is an outdated figure. As we speak, it is much more than that. On daily basis, there is $7.5 trillion in foreign exchange transaction, more than that as well. Meanwhile, our brothers who are working hard to prepare for COP31, here in Turkey, in Antalya, they will be struggling about two things. Amazing figures. $100 billion that was committed back in the time of the preparation of the Paris Agreement in 2015, and we're wrapping that up in 2025, and then the new figure is 300 billion. So I'm talking here billions, and none of that is coming to climate and climate finance is development finance, while the system is funded, as mentioned as well by the governor of Bank Negara Malaysia about the links to the SDGs. Don't have finance. We are talking here globally, not in any of your countries. Globally, we are not on track to achieve the SDGs, with few exceptions. Less than 20% of the SDGs targets are on track, and we are only 4 years away from the finish day. Less than 20%. 50% either significantly or slightly off track, and worse than that, that roughly more than 30% are worse than we were before when we started the SDGs back in 2015. And in order to achieve that, it's basically about what we discussed here, about linking capital, productive capital, to substance when it comes to goods, services, job opportunities, inclusive growth. And that will get me here into quick round of questions, and then we'll open it for the distinguished participants from the floor. If we have any questions, please be ready. And I'll start with His Excellency, the Governor of the Central Bank of Turkey, Dr. Fatih. Again, we are still on the theme of capital monetary stability. First, you mentioned, but briefly, now this is an opportunity to elaborate, Excellency, to what extent Islamic finance principles are compatible with conventional or traditional central bank mandates? I think this question is as old at the start of the very transaction based on Islamic law. To what extent the compatibility is there, and the role of the central bank and as a monetary authority and prudential regulator to assure this kind of financial and then, of course, monetary stability. And the second question to you, sir, is basically about the lessons drawn from the many crises that we have been seeing during the last, I would say, 5-6 years, by the start of the COVID, variety of wars, then some shocks, including from policy stance and behaviors by some of the major countries. So these are your two questions, sir. Compatibility between conventional and Islamic, and how we manage shocks.
Well, thank you. Great questions. I'll try to be brief. The first one, I would say they're highly compatible. If anything, it's more than that. I think there's a lot of complementarities between what Islamic finance institutions do and what central banks are trying to achieve. So let me maybe elaborate on it with one important example. What are the central bank mandates? In most parts, it's price stability and financial stability and payment systems, of course, but most, basically it's macro financial stability.
Yeah.
Broadly speaking, I think that's a nice way to summarize it.
Yeah.
And for a lot of the countries, for some countries, including Turkey, an important aspect of macro-financial stability is actually the current account balance.
Yeah.
Some of our countries run structural deficits. I think Turkey is one of that. What does that mean? Well, on average, we run a current account deficit. In periods where the country grows stronger, the current account deficit widens.
Yep.
And when the economy is weaker, the current account deficit is weaker. And it could even turn to surplus. But this is a vulnerability of many economies. If you're running a current account deficit, it makes you more vulnerable to external shocks, to changes in sentiment, and to basically external changes in external conditions, to external developments. So it is an important theme to try to address this structural vulnerability. And the way I think about that problem, the current account, is basically it's an imbalance between savings and investment. We tend to think of it as the imbalance between imports and export, but a nicer way, a more fruitful way to think about that is savings and investment.
Yeah.
Our country is one in which the investment demand is huge. You have huge growth potential, but you need investment for that. And unless you can channel the funds for investment from domestic savings, you need to borrow from abroad, and that leads you to run a current account deficit. So how does the Islamic finance help here? Well, it helps through financial inclusion, because there are parts of the society that do not want to save using traditional instruments. And so in the absence of, Islamic instruments, they would not either not save, or their savings would be outside the banking system. So Islamic finance helps us here quite a bit, the participation finance institution. I think we still have, for example, a lot of savings that are outside the banking system. I emphasized the gold under the mattress early in my first part.
You did.
That's quite a large amount of that is staying outside the banking system.
Yeah, the leakage,
Those
the
are
hoarding part.
Yeah, those are funds that are not, they cannot be channeled into productive investment because they're not part of the banking system. So it's really critical that this part of the finance industry grows and it offers a richer set of alternatives. So that's number one. The second one, I think the second question is also really helpful. If I look back, what we've learned, over the last 5-6 years. I mean, if you look back, starting with COVID, we've had the COVID, then we have had supply chain disruptions, then we've had the Russia-Ukraine war, now we have the war in the Middle East. We've had in different parts of the world issues related to food supply because of climate issues and so on. So basically, this is a period of supply shocks. It's very different from the couple of decades before that, where it was more driven by demand. Central bank tools are excellent in dealing with demand, changes in demand conditions, but the trade-offs are a lot more difficult when dealing with an environment with larger and frequent supply shocks. And clearly we are in that era now. This is not going to be the last supply shock that we're going to have probably. And so central banks need to be prepared for, I think, what is to come. Now, in terms of what we learn from that, I think buffers help a lot. I think what we're learning now is that having strong international reserves is really important. Minimizing your vulnerabilities, the current account, is really important. We've entered this period with 1.9% of deficit. If you compare that to when the Russia-Ukraine war started, which is a similar event in terms of ramifications, the current account deficit was much wider, and the reserve position of the central bank was much weaker, and the policy stance was very different. So all of these three things combined has allowed us to manage this really well. Our trade balance was, the trade data was released yesterday. The last 2 months of data show extreme resilience.
Yes.
We don't see a large widening in our current account deficit because the policy tools that we put in place and the buffers that we've accumulated so far are helping us effectively manage this episode much better.
Right. Thank you so much, Governor. You covered the 2 questions and actually added one of your own because you got something to do as well with how you internally manage these things in a time of perma-crisis. Because in the past we say, well, these crises would come and visit us every longer cycle than what we have seen recently. But it's kind of a feature that it's permanent crisis or perma-crisis as being summarized in an interesting book of that title, co-edited or co-authored by one of my good friends and brothers, Muhammad Al-Irian, with Mike Spence, the Nobel Prize laureate, and Prime Minister Brown. It's available if you want. They did that 2 years ago and didn't capture some of the recent crises. that we are facing now, including, of course, the crisis in the Middle East. Governor, I know that you have a special time constraint because you need to catch your flight, but I know that you wanted to share more in areas related to how the Malaysia being a leading jurisdiction and linking Islamic finance to the broader financial sector development, I would dare to say to the broader economic and sustainable development objectives as well. What could be shared in terms of connecting Islamic finance to inclusion and sustainability? Another question, if we have the time with you, is basic about the value-based intermediation, and this is again issues related to not just adhering to the rules and making sure of aspects related to compliance by ticking boxes, by going beyond that into the substance when it comes to the economy and the welfare of the society and the sustainability environment. And I know that you can capture them all at once. And then how can you do that while many countries we know are suffering from the burden of debt, where there are many measures of debt, as we know. But the measure that I like really is debt service to exports or debt service to public revenue. But more importantly, how much is your interest paid compared to what you spend on essentials like education and health? And we know that many countries, last statistics, for instance, from Africa, that 20 countries from the African continent are spending more on their debt service than what they spend on education and health combined. So these three questions packaged for Your Excellency's interest and discretion to pick and choose.
Thank you, Dr. Mahmood. Let me just touch on the first question in terms of regard to integration of Islamic finance into the ecosystem itself. I think this is very important because I think Islamic finance plays an integral role to effective financial intermediation. And effective integration requires, I would say, robust monetary and financial ecosystem to be in place. What do I mean by this? I think what must be there? I think first, definitely in terms of well-functioning Sharia-compliant liquidity management. So that's very critical. Second, in terms of having a deep Islamic money and capital markets. So that's one of the important, I would say, component that we developed to ensure that we are able to have a complete ecosystem for Islamic finance to grow. And third, in terms of course, I think Dr. Fatin mentioned about this as well, in terms of financial stability, that's one of the mandate of the central bank. We need to have a robust regulatory and legal infrastructure. So in the case of Malaysia, of course, I think we recognize in our Central Banking Act that we have a dual banking system, both conventional and also Islamic. And second is that we have a different set of regulatory framework, although it is about the same in terms of the fundamentals, but the Sharia aspect of it is a bit different. So we have the Islamic Finance Services Act that governs the operations of the Islamic banks. Fourth is in terms of having the diverse market participants and also instruments in place. So that's why in terms of the kind of players that you have in the market and the instruments that you introduce. So that's where we want to move more towards more of risk sharing instruments in the market itself. So this is where I think it's very important to build the ecosystem itself. And one development I want to share in terms of, in the case of Malaysia, is with regard to the benchmark rate. Of course, I think globally we're moving away from the interbank overnight rates, I think, which is more of submission-based. Similarly, we are also moving towards more of transaction-based reference rate. And what we have also done, we have created a specific benchmark rate for Islamic finance. So we call it the commercial one, we call it the Malaysian overnight rate, or MAIOR. For the Islamic is MAIORI, the Malaysian overnight rate for Islamic finance. What we have done is that we have mandated the use of this MAIORI as a transaction-based Islamic benchmark rate for the Islamic products beginning second half of next year. So now starting on a parallel basis, by next year, all must be on this. And this is important because I think as the MYORI reflect actual overnight Islamic interbank placements, it provides a very strong benchmark that is reflective of the Sharia compliant market activity. And this shift is expected to make pricing more transparent, and this will support an end-to-end Sharia compliant solutions for the Islamic financial institutions. So this is what we have done. And of course, I think looking in terms of the composition of Islamic financing as a total finance for Malaysia, it's not at 48%. We will breach the 50% mark, perhaps I think in 1 or 2 years' time. So it's also important for us to see how does Islamic finance fits in under the modern money framework. So that's why how do we think about how do you conduct monetary policy where you have half of your financing are actually under Islamic finance. So we're looking into this as well. We are doing revision on our monetary policy framework, and one of the elements that we're looking at is in terms of how do we conduct monetary policy under the Islamic finance environment, where Islamic finance is more than conventional financing. And what are the kind of instruments that you need to facilitate this? So these are the ecosystem that I thought is very important. VBI is something that we started from 2016, a value-based intermediation. In terms of what we are focusing on is really in terms of impact financing. What will be the impact that you get from every dollar of financing that you give to a customer, be it a household or be it corporates, SMEs or even large corporates. So we have grown in this, and we have now sharpened in terms of how do we measure the impact itself. So we have produced a paper, a discussion paper in terms of what will be a policy document actually, in terms of what will be the framework of measuring impact from the financing that you have actually granted. So that's the third part. I think the final questions, I think, is quite broad in terms of how do we manage in terms of debt servicing, more from the country perspective, I would say. I think if you look at the government, we have recently came up with an act. We call it the Fiscal Responsibility Act that manage in terms of the consolidation of our fiscal deficit. That's number one. Second, as a discipline that limits in terms of the debt of the economy. Yeah. It cannot go beyond 60%. Mm-hmm. So that's what I think is very important. And so this is where at the government level, there's this fiscal discipline that has been embedded through this FRA, and this has helped in terms of...
and this is the overall debt.
Correct.
Public, external, and domestic.
Public, yes, exactly. And for the corporates, I think we also have this arrangement in terms of making sure that we want to grow more of non-debt-based financing. I think if you look even at the household, I think we have about household debt to GDP of about 86%, which is quite high at this point of time. So this is where we're trying to reduce it down, to bring it down. So that's where I think coming out with the products that have a non-debt-based financing, that will help reduce debt-based financing for the corporates and also for the household. So that's where some of the products that we have, for example, I forgot the name, but it's more about like factoring services, where you can discount your invoice and get financing from the institutions. So that also relates to creating more opportunity for non-debt-based financing. So that will also address in terms of from the government side and also from the corporates and household sides.
Right, thank you so much. You tackled the three challenges, the three questions, not just by highlighting them, but providing solutions as well. Thank you so much, Governor, for that. And let me turn to Mr. Yahya, His Excellency, the Governor of the PMA, the Palestinian Monetary Authority. Two related questions, Excellency. One is basically about, as you highlighted in your first intervention, we are living in this environment of radical uncertainty globally. And of course, as the Governor of the Central Bank of Turkey said, if you are already with your good buffers, with resilience, these kind of shocks could be absorbed better. There could be an impact, negative impact, but the impact will be much more manageable than otherwise. But what can we do more if there are some inherent kind of elements of instability and fragility? And what could be the role of Islamic finance to help in dealing with this issue as part of a toolkit?
I guess more supervisory and more coordination among the regulatory, the Ministry of Finance and the Sharia boards. And maybe in the design stage, stepping into the design stage for the different products, that would eliminate, of course, the rapid volatility and the wrong growth of the capital. So I guess when the central bank steps in along with the different parties and they coordinate together, then you will have better protection.
Right. And related to that, and you mentioned, Your Excellency, the role of Islamic banks in the case of your operations. And here, and you did really a great role in maintaining liquidity, efficient payment system despite the circumstances. So what tools matter the most in fragile and vulnerable costs? Have issues related to liquidity facilities, digital finance and banking, SME finance, risk-sharing instruments.
And close supervision and close monitoring and live monitoring with the banks and coordination together. That's really what safeguarded us in our case in the last 3 years. So working together, sometimes you even have to alternate from being a central banker to being a finance minister to being a Sharia board. And so being resilient and being really situational in such cases.
Right. Okay. We have a few minutes of. All right. I think we need few hours now because of the raise of hands. All right. So do you have a microphone ready, colleagues on the organizers? Yes, sir. Can you? Yes. With the lady at the front. Can you?
Assalamu alaikum. I am Sidra Iqbal. I'm a journalist from Pakistan. And since we have the esteemed presence of
Can you introduce yourself, please?
Yes, I just did. I am
Sorry, I
Sidra.
was interrupted.
No worries at all. I am Sidra Iqbal. I'm a journalist from Pakistan with a particular focus on business and economy. Since we have the esteemed presence of 3 governors with very unique economic situations and scenarios to take care of, I'm very interested in knowing that if each one of you was advising a developing country today, what would your advice be? Would it be to attract more capital or improve the quality around the governance of capital already available? Thank you.
Striking the balance between more and the quality of what you have. There was another question in the back there. Can you please pass the microphone to the 3rd row? Yes, sir. Please take the floor. Introduce yourself. Yeah.
Barakatuh. My name is
Alaikum
Mohammed Darwish. I'm from the CEO Office of Emirates Islamic Bank, Emerson BD Group from UAE, Dubai. So the question to the regulators, is there any possibility to give certain incentives to the financial institutions, those they provide capital facilities to entrepreneurs that they are willing to engage with the real economy transactions? And is it fair to say, based on all these discussions, that the Islamic finance sector is more liquid than the conventional, which needs to be attracted more to the banking systems and to try to redirect it to a specific real economical transactions, which hopefully will add value to the economy? So that's the questions. Thank you.
Right, 2 questions from you. And we have the very last question. I was hoping to have more. As you can see, the organizers, as always, gave us more constraints on time. So this is the last question. Introduce yourself, sir. Yeah. Yeah, it will work. Yeah, just keep it close to your mouth. Yeah, speak. Not working?
Yes. Excuse me, now it's okay. Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Ahmed Murat from Alpha Group Oil and Gas Trading Investment. And my field is the energy. I want to ask one very important question that mentioned Mr. Yahya in speech.
Yeah.
Large infrastructure and projects like energy, LNG, infrastructure, logistic, require billions of dollars. And in long-term capital, what reforms are needed for sukuk markets to finance projects at the scale more effectively? Thank you very much.
Thank you.
Right. Thank you so much, and apologies for those who raised their hands and we couldn't give them a chance to intervene. And yeah, so you can pick and choose
Oh,
three
absolutely.
important questions. We can start by you.
Thank you. Thank you so much. So as I mentioned, we started with the Istidama about $300 million, and that was dedicated actually back during the COVID for the clean energy. And it was actually at preferred rates, and it's grew now to 700 million. The problem for the clean energy now is the land. We will get very political. The 60% is a land that is classified as per Oslo as Area C. So there is not enough land to really have a clean energy at scale. So whether you come up with a supported clean energy in order to bring the clean energy to that, unfortunately, whatever financial mechanism, whether it's sukuk or others, and it's subsidized by us, still you have a problem if really offering land to put that much of photocells and create solar energy. We have much challenge now with this current Israeli government and the reclassification now of the Oslo A, B, and C areas, and we were talking about that yesterday. So you need at scale, and unfortunately we cannot offer at scale. However, when it comes to subsidies and a preferred interest rate or profit rate by the central bank, as I mentioned, we have Istidama about 700 million, and it's directed towards the solar energy subsidies projects.
Right, and based on other countries' experience that we know now, that is much more cost effective to get your electricity from solar and wind in the form of renewables, but the challenge is with the grid and storage.
Absolutely.
This is basically what needs more investments than what we imagined before. Thank you so much as well for your reaction, sir. Mr. Governor.
Thank you. Thank you. I think I'll answer two questions. The first, in terms of the capital, I would say it's more of the kind of capital that you attract. I think it has to be quality capital. And second, I would emphasize more in terms of the governance surrounding the capital itself. I think before we attract even more capital into the country. The second question, in terms of, I would say that Islamic finance with its the value proposition that it carries would certainly have greater attractiveness regard to financing for corporates and even the SMEs in particular, especially if you link this back to the kind of products that Islamic banks can offer, because they can offer more of a supermarket kind of products. I think beyond, traditional commercial banking, but also investment banking kind of products as well, given the kind of, wide scope of activity that they can get involved into. And the third is that because the flexibility that can come in through blended finance approach, so that's where you can then bring down the overall cost of financing for the borrowers. So I think that could be an attractive value proposition for the borrowers.
Right.
I'll stop there.
Thank you so much, sir.
Very quickly, the question on the advice to developing economies. I agree with Governor Abdul Rashid. I think governance matters a lot when it comes to capital, and we need both better capital, but also more capital. I think it's yes, quality is very important, but also given all the needs of this day in light of everything that's going on, I think that the quantity also matters. I think here we need deeper capital markets. We need a lot more products to deepen capital markets. I think that will improve both quality and the quantity at the same time. And I think better supervision, stronger institutions would be key.
Right, Excellencies, ladies and gentlemen, this was a wonderful session. Didn't in any moderation of sessions recently took as many notes after the speakers as hints of things that we can discuss further in the future. I'm very grateful to the three of them for their openness. Normally get this kind of very conservative approach from the governors of central banks. but you have seen them very open, ready to share ideas. Then I had a lengthy concluding remarks because of the time constraint. I will save you that. But basically, three quick takeaways. First, there is no dichotomy whatsoever between maintaining stability of finance, maintaining stability of price level, and achieving sustainable development. Actually, they are prerequisites and preconditions for any serious inclusive growth and sustainable development. Second is not just about innovation and some transactions here and there. It's basic about solid institutions, well coordinated, predictable. In times of uncertainty, you go for regulators for trust and confidence in the system through predictable policies. And finally, you see that it's not just within the jurisdiction, cooperation matters, and that needs really to be with open minds when it comes to standards. And then, very, very finally, I like these issues, again, from the analogy of Istanbul and its magnificent bridges. Finance matters, markets matters, but it's all at the end for the benefit of the people and for the protection of the planet. In the very session that we had here, when Wahed came in the conversation, one of the innovations that happened, they reminded us of the great companion of the Prophet sallallahu alaihi wasallam, Abdul Rahman ibn Auf, when he was offered help and support by one other companions from Al-Madinah. He said, well, he's an entrepreneur, he's a trader, he knows how to do business. He didn't say, well, give me money, but he said, well, show me the way to the market. But that market is a disciplined market, had people working on it. So he had the finance, the knowledge, the market is there, the welfare of the people was the ultimate goal, even from the very origins of the principles of finance in the time of the Prophet ﷺ, till now, when we're trying to have some sort of enlightened knowledge from the great seerah of the Prophet and his companions. Having said that, I'm very grateful to the opportunity. Thank you all. Please join me thanking the governors. Thank you.
Thank you, Your Excellencies, for that outstanding panel discussion. Apologies for rushing the final bits of it. We are on a very tight schedule. On that note, I'd like to invite the President of the Investment and Finance Office of the Republic of Turkey, His Excellency, Mr. Burak Dağlıoğlu, to present a token of appreciation on behalf of the Global Islamic Economy Summit here in Istanbul to all of our contributors who have shared their experiences with us here on this stage. Thank you very much. Ladies and gentlemen, let's hear it for our panel.
Thank you so much.
Thank you. Esteemed guests, our next keynote address is titled Turkey's Participation, Finance Ecosystem and Capital Mobilization, the Role of Financial Centers in Attracting Capital. And it will explore Turkey's growing participation finance ecosystem and the strategic role of financial centers in attracting and mobilizing capital. Please join me in welcoming His Excellency, Mr. Ahmet İhsan Erdem, the Chief Executive Officer of the Istanbul Financial Center, for his keynote address. Buyurun efendim.
So, I know that I am the only obstacle between this session and lunch and Jummah prayer. So I will be as fast as possible to convey my messages. Ladies and gentlemen, excellencies, distinguished participants, I would like to extend my welcome to you all to Istanbul Financial Center, the new center of finance in Turkey and the region, and also would like to welcome you all global third annual Global Islamic Finance Summit that takes place in Istanbul. And I would like to extend my appreciation to organizers, Al Baraka Forum, Investment Office of Turkey, Turkish Wealth Fund, and other supporting parties as well to make this gathering happen third times in a row. Ladies and gentlemen, in the past 3 years, scholars, policymakers, industry leaders were here with us today. So eventually it leads to many fruitful discussions. Inshallah, those will be paved the way for concrete results in order to increase the density of Islamic finance in the world and providing an ample alternative to conventional means, obviously, that they are not very helpful to finding solution to very problems that we have all facing. And this year's theme of the conference is the capital in the Islamic economy, structuring wealth for sustainable development. And in my opinion, it's a very timely discussion point since, as I said, the world is going through turbulent times in terms of distribution of wealth equally, justly, and continuing the sustainable development efforts. Islamic finance is not just an alternative for observant Muslims, but also an alternative paradigm for the whole world. And yes, we are living in a time of uncertainty. We have ongoing wars within our region. In this regard, I would like to also express my solidarity to people of Gaza and our brothers and sisters in the region who are suffering from ongoing wars. And the rising economic tensions, trade barriers also make it hard for investors to make long-term commitments and long-term investment plans. And in this regard, especially financial sector and capital increasingly seeking stability, operational efficiency, and a welcoming regulatory environment. And in this very scene, financial centers comes to picture. Financial centers is a composition of both a physical infrastructure as well as a ecosystem by itself. It provides sort of secure playground for financial industry by providing long-term planning window, because financial centers often enshrined with long-term tax incentives and long-term commitments from the very governments who set the financial centers. And on top of that, continuity of the operations, safe and sound and secure, is also very important and critical right now. I would like to also share our experience as an international financial center. Istanbul Financial Center, as you may know, is a governmental project. The preliminary work of the Istanbul Financial Center dates back 20 years ago, initially planning, conceptualizing the Istanbul Financial Center, planning and making the groundwork, investing in the physical infrastructure, also working on the regulatory framework that will address the needs and necessities of the international financial services community. And today, Istanbul Financial Center is operational in terms of both physically, and it also has a regulatory framework. Basically, we can say that Istanbul Financial Center has two main components: the physical infrastructure as well as the regulatory framework and ecosystem effect that it possesses. Today, currently 20,000 people are working in Istanbul Financial Center. Whole state-owned banks and enterprises also move their operations to Istanbul Financial Center, as well as at the very center, at the very core, Central Bank of Turkey is also operational in Istanbul Financial Center. Basically, what I can say is, in the Istanbul Financial Centers, 4 major activity areas are supported through lucrative incentive systems and operational ease. If you allow me to count them, first is, of course, financial services export activities. And the other one is qualified regional offices outside of the financial services spectrum that put their hub into Istanbul Financial Center and serve across the region. And the third one is transnational trade, is also another important activity area that is supported in Istanbul Financial Center. And of course, financial technologies is the last but not least, is also another area that is supported in Istanbul Financial Center through integrated fintech zone, financial technology zone, that is an important playground for financial technology companies, get together with the ecosystem, other components of the ecosystem. Well, this is our layout as the Istanbul Financial Center. But of course, establishing a financial center should always lean on a broader rationale, which are the core competences of a nation that really matters in composing or creating a financial center. And I can share our story, our perspective as Turkey, the rationale behind putting a financial center at Istanbul. There are 4 main pillars that we lean on while addressing our activities as the Istanbul Financial Center. The first is location. As you know very well, many of you flew all around the world. Istanbul has always been a center for logistics, trade, historically a center for civilization. And with the investments have been done for the past 20 years under the leadership of His Excellency the President, Mr. Recep Tayyip Erdogan, turned into a world-renowned logistics hub. When you put Turkey in the middle, Istanbul in the middle, and draw a 4-hour flight zone, you can access 1.3 billion people, almost $30 trillion of economy from your offices in Istanbul. Second pillar that is very important is Turkish economy itself. As you know, Turkish economy is one of the largest economy in terms of purchasing power parity, is the 11th economy in the world. It has a diverse economic composition, namely Turkish economy does not lean on just one major driver of economic activity, so it is rather very resilient to any shocks that can emerge. And the third one is the human capital itself. Turkish population is around 86 million people, and half of this population is under the age 33, and it is the youngest youth population of Europe. So this young youth population is also through investments in our educational infrastructure has turned into an important talent house and human resources capital for not just the needs and necessities of our country, but in globally. Today, many Turkish citizens across the globe is working in international companies and very important positions in the financial services industry. So human capital is one of the most important aspects while creating a financial center. And the last but not least is Istanbul itself. Istanbul is one of the most visited cities in the world. It is one of the most vibrant cities in the world. It has rich culture, history, and the necessary infrastructure for both executives and international expat community to live their lives and run their businesses easily without facing any hurdle. And to sum up the picture, international financial centers are really important in the sense of creating long-term decision-making windows, providing long-term decision-making platforms for international financial services community, as well as creating a pilot application platform for innovation and newly emerging ideas and applications in the international financial services community as well. And creating an international financial center should always lean on a way deeper rationale that get its support from the core competences of a nation or of a country. That being said, I would like to conclude my remarks over here. And so far, it's been a very important platform for exchange of ideas. I hope we all broaden our horizons to create concrete connections for the future endeavors as well. Well, thank you very much. Assalamu alaikum.
Thank you, Your Excellency, for that speech and walking us through the importance of the Finance Center here in Istanbul. Ladies and gentlemen, we've come to the end of the morning program of the summit. Just a couple of announcements to make before you all leave the room. Jummah prayers will be conducted just outside the hall. If you guys enter the conference, the hallway that is right in front of the VIP rooms, Jummah prayers will be formed there in sessions. You can either take part in that, or if you would like to pray in the mosque, Mimar Sinan Mosque is just down the street from the financial center. But I would like to emphasize and let everyone know that you need to be back here by 1:30 to 2 p.m. latest. No one will be allowed back in 2 p.m. onwards. Thank you very much and enjoy your break.